Welcome to ZICA Academy YouTube channel. In this lecture, I want to examine the Consolidated Statement of Profit or Loss of foreign subsidiaries. This is my second video on foreign subsidiaries. If you are coming across my lecture for the first time, please like the video, also share it with others. If you are a returning subscriber, I say thank you for being part of this channel. I've told you in the first video that a foreign subsidiary is a subsidiary that is located in a foreign country. A subsidiary that is located in another country is said to be the foreign subsidiary. What are the procedures for preparing the Consolidated Statement of Profit or Loss of a foreign subsidiary? The first step is to draw the group structure. Draw the group structure. I've told you that a group structure is a diagram that shows or explains the relationship between the members of the group. The diagram that shows the relationship between the members of the group is said to be the group structure. And different forms of group structure exist. We have the simple group structure, which may involve one parent and one subsidiary, or one parent, one subsidiary plus an associate. That is simple group structure. We also have fellow subsidiary, in which two or more companies are subsidiary of the same parent, but they are not subsidiary to one another. We also have a sub-subsidiary or a vertical group, in which an entity is a subsidiary of another entity, which itself is subsidiary of the parent. We also have the mixed group, where the parent company have both the direct and indirect interest in another entity or in their sub-subsidiary. So the first step, as I've said, is to draw the group structure. The second step is to update and translate the statement of profit or loss. Statement of profit or loss of the foreign subsidiary or the foreign subsidiary. You update it. Two things are involved. The first thing is to update. The second one is to translate the statement of profit or loss of the foreign subsidiary. To update means you bring the financial statement, that is, you bring the statement of profit or loss of the foreign subsidiary up to date by including those things that ought to have been there, which were omitted from the financial statement of the foreign subsidiary. Those things that need to be included in the statement of profit or loss, which have not been recorded, we need to include them to bring the financial statement, to bring the statement of profit or loss of the foreign subsidiary to date. The second step after updating is to translate. To translate, it means you translate it from the financial statement, from the foreign currency. You translate the statement of profit or loss from the foreign currency to the presentation currency of the parent. I've explained what the foreign currency means in the first video, the presentation currency and different exchange rates we have. So you translate it from the foreign currency to the presentation currency of the parent. So, and what rate of exchange should be used? You should use the spot rate, where the spot rate is an approximation of the average rate. Where the spot rate is not known, that means you should use the average rate throughout. I've told you the rate of exchange prevailing at the time of transaction, that is the spot rate. So if you want to translate the statement of profit or loss, where the spot rate for each of the transactions are not given, you should use this average rate for the period, average exchange rate. That is the second step. After updating and translating, then the next thing is to prepare the consolidated schedule. Prepare the consolidated schedule, bearing in mind to eliminate the intragroup balances. Intragroup balances should be eliminated. Prepare the consolidated schedule, and you should ensure intragroup balances are eliminated. The next step is to calculate goodwill in foreign currency. Calculate Goodwill in foreign currency. Calculate goodwill in foreign currency. Then the next step is to calculate the exchange gains. Exchange gains or loss on goodwill to be included in other comprehensive income. Exchange gains or loss on goodwill to be included in other comprehensive income. Remember, I put gains in bracket. If it is loss, positive. It means goodwill translated at opening rate. Then you also calculate goodwill. You translate goodwill. Goodwill translated at the closing rate. Where the goodwill translated at the closing rate is greater than the goodwill translated at the opening rate, you get the exchange gains. Where this is greater, that is where it is negative. So you have exchange gains minus or loss on translation of goodwill. 6. Calculate the exchange gains negative or loss on translation of subsidiary net asset. To calculate this, you have the opening net asset, translated at opening rate. Then opening net asset translated at the closing rate. Then you have the exchange gains or loss on translation of the subsidiary net asset. Exchange gains or loss. Then translation of profit or loss for the year. The year, this will be translated at opening rate. Then profit or loss for the year translated at average rate. So you have the exchange gains or loss. Exchange gains or loss. The sum of these will give you the exchange gains or loss to be included in other comprehensive income. So this value will be included in other comprehensive income. Exchange gains on translation of goodwill and exchange gains on translation of subsidiary net assets will be included in other comprehensive income. These are the steps you need to follow when you are preparing the consolidated statement of profit or loss of a foreign subsidiary. Now let's take question as work example. Keep watching. ICAN November 2024 corporate reporting question number 1. Buga PLC operates chains of bakery in the country which sells various types of bread, whole wheat bread, cassava bread, cake bread, etc. The company's accounting year ends September 30. On October 1st, 2022, Buga PLC acquired 80% interest in the ordinary share capital of Kumasi Limited, a company that produces and distributes wheat located in Ghana. Buga PLC has no other subsidiaries. The draft financial statements of Buga PLC and Kumasi Limited are as follows. Draft statements of profit or loss and other comprehensive income for the year ended September 30, 2023. We have Buga PLC amount in million naira. We have Kumasi Limited in million Ghana cedis. Revenue 3,784 and 9,892. Cost of sales 2,480 and 7,084. Gross profit 1,304 and 2,808. Other operating income 314 and dash. Operating expenses 700, 3,776. Profit or loss before taxation 918 and 968. Income tax expense 118 and dash. Profit or loss for the year 738 and a loss of 968. Other comprehensive income or loss, we have nil and 1,132. Then we have total comprehensive income or loss 738 and a loss of 2,100. Draft statement of financial position as at September 30, 2023. Buga PLC and Kumasi Limited. Buga in million naira, while Kumasi Limited in million Ghana cedis. Non-current assets. Property, plant and equipment 2,546 for Buga, 4,890 for Kumasi Limited. Financial assets. Investment in Kumasi Limited 1,296. Amount owed by Kumasi Limited 728. Total non-current assets 4,570 and 4,890. Net current assets 616 and 2020. Total assets 5,186 and 6,910. Equity and liabilities. Equity share capital 3,000 and 1,000 for Buga and Kumasi Limited. Retained earnings on October 1st, 2022, 1,056 and 4,010. Profit or loss for the year 738 and 968, a loss. Pension reserves nil and 1,132. Total equity 4,794 and 3,710. Non-current liabilities, deferred tax 392 and nil. Loan notes owed to Buga PLC nil and 3,200. Total equity and liabilities 5,186 and 6,910. Additional information. 1. Buga PLC paid 7 billion Ghana cedis for its investment in Kumasi Limited. As Kumasi Limited is not a listed company, Buga PLC intends to use the proportion of net asset method to value the non-controlling interest. 2. Kumasi Limited prepares its financial statements using Ghana GAAP. Although there are similarities between Ghana GAAP and IFRS, there are differences in pension accounting and deferred tax, which is not recognized under Ghana GAAP. 3. In the year ended September 30, 2023, Buga PLC bought wheat from Kumasi Limited for 5,880 million Ghana cedis. Buga PLC paid for the wheat on delivery, and there was no debt owing to Kumasi Limited at the year end. At September 30, 2023, Buga PLC inventories include 360 million naira of wheat bought from Kumasi Limited and charges markup of 30% on cost of sales. Note 4. Buga PLC other operating income comprises a management charge to Kumasi Limited of 1,506 million Ghana cedis for management support given to Kumasi Limited. This charge was paid by Kumasi Limited on September 30, 2023 and is included in Kumasi Limited's operating expenses. In future years, there will be no management charge, as it is expected that Kumasi Limited will not require Buga PLC management support. Note 5. Kumasi Limited has a 2 billion Ghana cedis tax trading laws arising in the year ended September 30, 2023. Ghana tax laws allow tax trading losses to be carried forward only against future trading profit. Kumasi Limited is expected to make a taxable trading profit next year. Kumasi Limited accountant has suggested that the Ghana tax authorities could investigate the 1,506,000,000 Ghana cedis management charge billed by Buga PLC to Kumasi Limited and challenge the recovery of Kumasi's tax laws. The tax rate for Buga PLC and Kumasi Limited is 20%. Note 6. In October 2022, Kumasi Limited set up a defined contribution scheme for its directors and has accrued a contribution of 1,132,000,000 Ghana cedis for the year ended September 30, 2023. This contribution was paid to the pension fund on October 15, 2023. Under the Ghana GAAP, pension contributions are recognized directly in reserves through other comprehensive income. Tax relief for pension contribution is claimed in the accounting year in which the cash is paid to the pension company. Note 7. On April 1st, 2023, Buga PLC made additional investment in Kumasi Limited when it provided a loan of 3.2 billion Ghana cedis to Kumasi Limited with interest payable at 5.25% per annum in arrears. Buga PLC does not require repayment of this loan in the near future. No adjustments have been made for this loan other than to include it in Buga PLC non-current assets at the rate of exchange at April 1st, 2023. Kumasi Limited has recognized the loan in non-current liabilities. No entries have been made in either company. In respect of interest on the loan, interest is taxed on an accrual basis. Note 8. At October 1st, 2022, there were no differences between the fair value of Kumasi Limited's net asset and carrying amounts, except for the valuation of land owned by Kumasi Limited. PP included land at cost of 3.12 billion Ghana cedis, which had a fair value at October 1st, 2022 of 4.64 billion Ghana cedis. The directors do not intend to sell the land. Ghana GAAP does not allow revaluations. Note 9. The following tax rules apply to property, plant and equipment (PPE) in Ghana. The first asterisk, no tax is charged on disposal of PPE. The second asterisk, depreciation is an allowable expenses for tax purposes. Note 10. Other information. Naira to Ghana cedis exchange rates were as follows. October 1st, 2022, 1 naira is equivalent to 5.4 Ghana cedis. On April 1st, 2023, 1 naira is equivalent to 4.4 Ghana cedis. On September 30, 2023, 1 naira is equivalent to 4.2 Ghana cedis. Average for the year to September 30, 2023, 1 naira is equivalent to 4.8 Ghana cedis. Required. Prepare Buga PLC Consolidated Statement of Profit or Loss and other comprehensive income for the year ended September 30, 2023. This question is obtained from Corporate Reporting, ICAN, November 2024. Now, let's have the solution to the question. Solution. The starting point is the group structure. Group structure. The questions will find that on October 1st, 2022, Buga PLC acquired 80% interest in the ordinary share capital of Kumasi Limited. Buga PLC acquired 80% ordinary shares of Kumasi Limited. So this is a simple group structure. involving one parent and one subsidiary company. After the group structure, the next step is updating and translating the subsidiaries' statement of profit or loss. Updating, working. Let me say this is working number 1. Working 2. Updating and translating. Updating and translation of Kumasi Limited. Remember, Kumasi is the subsidiary. Kumasi Limited statement of profit or loss. We have the amount in naira, million naira. Then we have exchange rate. We have amount in Ghana cedis. Ghana cedis in million. The first item is revenue, 9892. Revenue 9892. After revenue, we have cost of sales. Cost of sales of 7084. 7084. After cost of sales have been deducted, you arrive at gross profit. So the cost of sales 7084, gross profit of 2808. 2808. After gross profit, we have other operating income, which is name. Operating expenses 3776. Operating expenses of 3776. Additional information. 1. Buga paid 7 billion Ghana cedis for its investment in Kumasi Limited. As Kumasi Limited is not a listed company, Buga PLC intends to use the proportion of net asset method to value the non-controlling interest. This is the consideration paid to acquire the investment in Kumasi Limited, and this consideration will be used in calculating goodwill on acquisition of Kumasi Limited. Note 2. Kumasi Limited prepares its financial statements using Ghana GAAP. Although there are similarities between Ghana GAAP and IFRS, there are differences in pension accounting and deferred tax, which is not recognized under Ghana GAAP. So the only difference in the presentation is the pension accounting and deferred tax, which was not recognized under Ghana GAAP. So there is nothing that require adjustment. Just know that when we get to the pension accounting and deferred tax, which were not recognized under Ghana GAAP, for this financial statement to comply with IFRS, since those items are to be recognized under IFRS, we will need to incorporate them into the financial statements. That is what we should take note of. Note 3. In the year ended September 30, 2023, Buga PLC bought wheat from Kumasi Limited for 5,880,000,000 naira, 880 million Ghana cedis. Buga PLC paid for the wheat on delivery, and there was no debts owing to Kumasi Limited at the year end. So this is a transfer of inventory between Buga PLC and Kumasi Limited. And remember, the intergroup transfer will be adjusted when we are consolidating. So since it has been incorporated into the financial statements, we need not to include them in updating process. Those items that have not been recorded in the financial statements, those are the items that will require updating. So take note of that. Buga PLC paid for the wheat on delivery, and there was no debts owing to Kumasi Limited at the year end. At September 30, 2023, Buga PLC inventories include 360 million. So this is inventory unsold, the one that have not been sold by the purchaser to the third party. That means the unrealized profit will be calculated on this 360 million, of which bought from Kumasi Limited and charges markup of 30% on cost of sales. 30 over 130 times 360. So the 130 is obtained by adding the 30% to 100 to get the transfer price of 130%. So that means to calculate the unrealized profit, we have 30 over 130 times 360 million. So that will be incorporated in the consolidated schedule. Let's leave that for now. Note 4, Buga PLC other operating income comprises a management charge to Kumasi Limited of 1,506,000,000 for management support given to Kumasi Limited. This charge was paid by Kumasi Limited on September 30, 2023, and it is included in Kumasi Limited operating expenses in future years. There will be no management charge, as it is expected that Kumasi Limited will not require Buga PLC management support. So this is an intergroup management charge. So you were told Buga PLC other operating income comprise a management charge. So the management charge of these have been recognized as other operating income. Remember, intergroup items should be eliminated. For management support given to Kumasi, the charge was paid by Kumasi on September 30, 2023, and is included in Kumasi Limited operating expenses. This is intergroup expenses. So since it has been included in the operating expenses of Kumasi Limited, you will need to remove it since it is intercompany items. But it will not be included in the updating process since it has been recorded in the financial statements. So we will only adjust for that in consolidated schedule. So we will eliminate it from operating expenses of Kumasi. Then we will also eliminate it from other operating income of Buga since it is an intercompany item. So we don't need that for now. In October 2022, Kumasi Limited set up a defined contribution scheme for its director and has accrued a contribution of 1,132 million. For the year ended September 30, 2023, this contribution was paid to the pension fund on October 15, 2023 under Ghana GAAP. Pension contributions are recognized directly in research through other comprehensive income. Remember, under Ghana GAAP, so you were told the pension contribution was recognized in research through other comprehensive income. But the IFRS requirement is that the contribution should be recognized as an expense in the face of profit or loss, not as other comprehensive income. So a reclassification is required now. So we want to reclassify it from the other comprehensive income to the face of profit or loss. So we will charge this as an expense in the face of profit or loss so that the financial statement will meet the requirement of IFRS. So we debit 1,132 pension contribution. Pension contribution 1,132. On April 1st, 2023, Buga PLC made additional investment in Kumasi Limited when it provided a loan of 3.2 billion Ghana cedis to Kumasi Limited, with interest payable at 5.25% per annum in arrears. Buga PLC does not require repayment of this loan in the near future. No adjustments have been made for this loan other than to include it in Buga PLC non-current assets at the rate of exchange at April 1st, 2023. Kumasi Limited has recognized the loan in non-current liabilities. No entries have been made in either company in respect of interest on the loan. Interest is taxed on accrual basis. Working number 4. We want to calculate interest payable on the loan, which will be recognized as a finance cost. So we have, remember, the loans was issued on the 1st of April 2023. And the year end is September 30, 2023. So the interest now that will be recognized, the rate of interest is given to be 5.25% per annum. 5.25% per annum in arrears. That is, it is payable at the end of the year. And the loan is 3.2 billion Ghana cedis. Interest from April 1, 2023 to the end of the year, which is September 30, 2023. How many months is this? We have April, May, June, July, August, September. 6 months interest is due for payment. Multiplied by 6 out of 12 months in a year. And how much is the interest that will be recognized? 5.25 times 32 times 6 divided by 12. So we have interest of 84 million Ghana cedis. 84 million. This interest will be recognized in the statement of profit or loss of Kumasi Limited as a finance cost. Finance cost. Finance cost of 84 million Ghana cedis. Note 8. At October 1st, 2022, there were no differences between the fair value of Kumasi Limited net assets and carrying amounts, except for the valuation of land owned by Kumasi Limited. PP included land at cost of 3.120 billion Ghana cedis, which had a fair value of, at October 1st, 2022, of 4.64 billion Ghana cedis. The directors do not intend to sell the land. Ghana GAAP does not allow revaluations. So since this is a land, and land is not a depreciable asset, so there is nothing that will affect the statement of profit or loss in respect of the note 9. The following tax rules apply to property, plant, and equipment in Ghana. No tax is charged on disposal of property, plant, and equipment. Since no tax is charged on disposal, so this will not be used in the tax computation. Depreciation is an allowable expenses for tax purposes. Depreciation is an allowable expenses. Since depreciation is an allowable expenses, so that means you don't need to add back the depreciation in the computation of the tax payable. So other information, these are the exchange rate. So when we are translating, it is then that this information will be useful. Since there are no further adjustments, so let's sum up these. 2808 minus 3776 minus 1132 minus 84. So we have 2184, a loss. And this loss is, so this is profit or loss before tax. After this, the next item is income tax expense. Note 5. Kumasi Limited has a 2 billion Ghana cedis tax trading losses, loss arising in the year ended September 30, 2023. Ghana tax laws allow tax trading losses to be carried forward only against future trading profit. Kumasi is expected to make a taxable trading profit next year. Kumasi Limited accountant has suggested that the Ghana Tax Authority could investigate the 1,506 million management charge billed by Buga PLC to Kumasi Limited and challenge the recovery of Kumasi tax laws. The tax rate for Buga PLC and Kumasi Limited is 20%. Now, you have been given the accumulated tax loss. Remember, no tax have been recognized in the financial statement of Kumasi Limited, since Kumasi hasn't recognized any tax. So you will need to calculate the amount of tax that is payable or receivable by Kumasi Limited. Since you have a tax loss of 2 billion, then you want to compute the tax payable. You start with the net profit or loss as per account, which is 2 billion. Then we have you were told they will challenge the recovery of Kumasi tax loss, then and the management charge. So the management charge of 1,506 million is not allowable since it will be questioned. You were told that Kumasi Limited accountant has suggested that the Ghana Tax Authority could investigate the 1,506 million management charge. It will be investigated because the tax authority is not sure that this management charge or intercompany management charge is a fair proportion of the amount of expenses that are wholly, reasonably, and exclusively and necessarily incurred by the business. So because of that, this amount that will be questioned or investigated is not allowable. So we take the tax loss of 2 billion, we add the non-allowable expenses of management charge of 1,506 million. Working number 3, computation of tax payable. Computation of tax payable. So this is in Ghana cedis, million. So we have net profit or loss in bracket before tax. The net profit, you are given from note 5 that you have Kumasi Limited has a 2 billion trading loss. So that is from note 5. 2 billion. That is the amount of the trading loss. And then you also have intercompany management fee, which may be questioned. Management fee of no trading loss is negative. Management fee is 1,506 million. We say it is not allowable. Note 6. In October 2022, Kumasi Limited set up a defined contribution scheme for its directors and has accrued a contribution of 1,132 million Ghana cedis. For the year ended September 30, 2023, this contribution was paid to the pension fund on October 15, 2023. Under Ghana GAAP, pension contributions are recognized directly in research through other comprehensive income. Tax relief for the pension contribution is claimed in the accounting year in which cash is paid to the pension company. So the cash relief is claimed in accounting year in which tax is paid to the pension company, and the cash was paid. This contribution was paid to the pension fund on October 15, 2023. So it was paid to 2020 to the pension company in 2023 accounting period. Since the funds was paid in 2023, October 2023, that means it will be available as a relief in 2023 accounting period. Therefore, we are going to claim the 1,132,000,000 as a relief. So we treat it as an allowable expenses in 2023 accounting period. Pension contribution. We want to allow it since it have not been used before. 1,132,000,000. Since there are no other allowable expenses, let's sum them up. Because note 6 on April, Buga PLC made additional investment in Kumasi where it provide a loan. It's all about loan. And note 8, there were no difference between fair value or Kumasi net asset. That is also fair value. Note 9, the following tax rules apply to property, plant, and equipment in Ghana. No tax is charged on disposal of PPE. Depreciation is an allowable expenses for tax purposes. And depreciation have been recognized. It has been used in the financial statement before arriving at the net trading loss of 2 billion. So you will not need to deduct that again. So since there are no other items now, how much will be the total profit or taxable profit? A loss of 2 billion plus 1506 minus 1132. We have a net loss of 1626. This is negative. Minus 2000 plus 1506 minus 1132. It gives you this. So this is taxable profit or loss in bracket. So since it is a loss, that is why we bracket it. So how much is the tax payable now? Tax payable, and the tax rate is 30%, 20% rather, at 20% from note 5. We were given the tax rate to be 20%. 20% of 1626. We have 325.2. 325 million Ghana cedis. Since this computation is negative, that means this will be tax savings, not payable. Income tax savings of 325. So we will add that. If it is positive, that means you pay tax on income. This is a loss. You claim a tax relief on the loss. But if it is profit, then it will be tax payable. So computation of tax payable or receivable. This is receivable. Receivable. So the result obtained is tax receivable. So minus 2184 plus 325. Then we have 1859. We have claimed the tax relief on the loss. So we have profit or loss for the year. Remember, the process we have just undergone is the updating process. We are still on updating. Back to the statement of profit or loss. After tax, the next item is items of other comprehensive income. Remember, the item that was recorded as other comprehensive income is a pension cost or pension contribution, which in accordance with Ghana GAAP was to be recorded as other comprehensive income. But based on IFRS requirement, the pension contribution or pension cost should be expensed in the face of statement of profit or loss. That is why this should be eliminated from OCI. We will not record it as other comprehensive income. Having completed the updating process, the next process or stage is translation. Other information. 1 naira to Ghana cedis. Exchange rates were as follows. On October 1st, 2022, you have 1 naira is equivalent to 5.4 Ghana cedis. April 1st, 2023, 1 Nigerian naira is equal to 4.4 Ghana cedis. September 30, 2023, 1 Nigerian naira equal to 4.2 Ghana cedis. Average for the year to September 30, 2023, 1 naira is equivalent to 4.8 Ghana cedis. Remember, we said the profit or loss items should be translated at average rate. So it means the 4.8 to 1 naira to 4.8 Ghana cedis, which is the average rate for the period, should be used to translate the profit or loss item. So in doing that, now it is naira that carries 1. And here, this is Ghana cedis. It is Ghana cedis that carries 4.8. So since Ghana cedis is not 1, if this were 1 Ghana cedis equal to 4.8 Nigerian naira, you will have multiplied. But since cedis is not 1, and cedis here is what we want to translate, and cedis is not the one that owns 1, so you divide. So we want to use 4.8 to convert to naira. 4.8 Ghana cedis, then 4.8, then 4.8. So 9892 divided by 4.8, that is approximately equal to 2061. 2061 naira. Then 7084 divided by 4.8, that gives us 1476 naira. 1476 approximately. If you subtract that, 2061 minus 1476, that gives us 585. Then 3776 divided by 4.8, that gives us 787. 787. Then 1132 divided by 4.8, that gives us 236. 236. 84 divided by 4.8, that gives us approximately equal to 18, which is 17.5, approximately equals to 18. So after this adjustment, what do you have? Then 3, let's adjust that. 585 minus 787 minus 236 minus 18. That gives us 456 negative. Then 325 divided by 4.8, that gives us 67.7, let's just say 68 approximately. If you add it, minus 456 plus 68, so we have 388, approximately equal to 388. We're done with updating and translation of the Kumasi statement of profit or loss. Then after updating and translation stage, the next phase or step is to prepare the consolidated schedule. Working number 5. Let's have consolidated schedule. Consolidated schedule. So we have a column for parent, and the name of the parent is Buga PLC. The currency is in Naira. After Buga PLC, we have subsidiary, which is Kumasi Limited. So we've translated the financial statement of Kumasi Limited to Naira. After this, we have adjustment. The adjustment, we will divide it into two. The debit side in Naira and the credit side in millions of Naira. After this adjustment, we have consolidation. In millions of Naira. Now, back to the statement of profit or loss. The first item is revenue. After revenue, we have cost of sales. Then after cost of sales, we have gross profit. After gross profit, we have other operating income. Other operating income. After other operating income, we have operating expense. Operating expense and finance costs, because finance costs have been included in the subsidiaries statement of profit or loss. Then after that, we have profit or loss before tax. Profit or loss before tax. Then after profit or loss before tax, we have income tax expense. So back to the statement of profit or loss of the parent. We want to include the amount from the parent company statement of profit or loss. We have revenue 3784, cost of sales 2480, then gross profit of 1304, other operating income 314, then operating expense 700. But this will require some adjustments. Then we have profit or loss before taxation 918, then income tax expense 180, then profit or loss for the year 738. So we want to record them now. Revenues of the parent 3784, cost of sales 2480, the gross profit of the parent 1304, other operating income of the parent 314. Then we have operating expenses is given to be 700. Revenue of subsidiary 2061, cost of sales 1476, gross profit 585. Then other operating income of subsidiary is nil. Operating expenses of subsidiary 787. Okay, the operating expenses of the subsidiary, let put other operating, we have written operating expenses and finance costs. So I want to sum up the operating expenses. This 787 plus 236 plus 18. Addition of these three items. Please take note. Addition of these three items. This plus this plus this. That is what I will record as operating expenses. Please take note of that. So 787 plus 236 plus 18. And that is totaled 1041. 1041. Addition of the three items. It gives me this. Operating expenses 1041. Then we have profit before taxation. If you subtract 1041 from 585, then you'll be left with 456. So which is profit or loss before taxation? A loss of 456. Please take note of that. Then we have income tax expense 68. Income tax expense of 68. If you add the 68, then you have the profit or loss for the year of 388. That is for the subsidiary. Remember, this loan was yield, the loan whose finance cost from working number 4. Please take note. This 84 was obtained from working number 4. This loan was yield by the parent company to the subsidiary company. Since it was yield by the parent company, that means subsidiary will pay the interest as finance cost. That is why we are subtracting that interest from subsidiary. Then the parent will receive the interest as an income. So if you like, you can put it separate, but I want to net it. If you subtract this interest of 18, the translated figure, from the finance cost of the parents, 700 minus 18, then you'll be left with 682. That is 682. That is the 700 minus 18. That is what gives me this. 700 minus 18. That is how I got 682. Please take note of that. 700 minus 18. This 18 was the translated figure of 84. And this 84 was obtained from working number 4. It was our working 4. Go back to working 4. I've rubbed it off from the board. So that is how I got, that is where I got this 84 from. When I calculated 5.25%, 5.25 divided by 100 times 3.2 million, 3.2 million, then times 6 months divided by 12 months. And that is how I got 84. 5% of 3.2 million, then interest of 6 months times 6 over 12. That is how I got this 84. And when it was translated, we got 18. This interest will be paid by the subsidiary. That is why it is a finance cost to the subsidiary. But to the parent, it is an income. So it will have been recorded separately as an income, a positive amount in the parent company statement of profit or loss. But since we are not to show that, since this was not shown separately, you can credit the expenses, you can credit the operating expenses. You know, if it were an expense, it would have been added. That means 18 would have been added to 700 to get 718. But because it is an income, you want to net it off the expenses. That is why we were deducting the income from the item of expenses. It is acceptable that way. But if you treat it as a separate line item in the parent company financial statement, no problem. The only difference is that what you have to note is that intercompany items should be eliminated. So we have netted off the interest from 680, from 700 to get 682. Then after this adjustment, how much is the profit or loss before tax? Then 1304 plus 314 minus 682. So we have 936. 936. This 700 is the operating expenses of the parent company. And that operating expenses was given in the parent company statement of profit or loss. You will see 700 there. But the finance income of 18, finance income of 18 has been deducted from the 700 to get the 682. Please take note of that. Then income tax expense. The tax expense by the parent. The amount of tax that was expensed by the parent is 180. Then if you go back to the parent company statement of profit or loss, you have tax expense of 180. If you subtract the 180 from 936, then you'll be having 756. 756. So that is the profit for the year. Let me say profit. This is negative. Let me note it. This is negative. So we have profit or loss for the year. Profit or loss for the year. No, minus 456 plus 68 will give you minus 388. So this is negative. So take note of that. So that is why I put this in braces. Note 3. In the year ended September 30, 2023, Buga PLC bought wheat from Kumasi Limited for 5.88 billion Ghana cedis. Buga PLC paid for the wheat on delivery, and there was no debt owing to Kumasi Limited at the year end. At September 30, 2023, Buga PLC inventories included 360 million of wheat bought from Kumasi Limited and charges markup of 30% on cost of sales. This is intergroup trading. So intergroup trading, we said we should debit the statement of profit or loss, and you debit revenue rather. Debit revenue with the average rate is 4.8. So we want to translate it to Naira. The debit revenue 5880 divided by 4.8. That is 1,225 million Naira. Then you now credit cost of sales. So we debit revenue, credit cost of sales. 5880 divided by 4.8. That gives us 1,225 M. So our revenue now under the adjusted column, we debit revenue. Remember, revenue is supposed to have a credit balance. If you debit it now, that means you are subtracting this 1,225 from revenue. And then you are, since cost of sales is an expense, if you credit the cost of sales, that means you are subtracting 1,225 from cost of sales. Now, we also calculate the unrealized profit. Provision for unrealized profit. And you were given a markup of 30%. 30% margin. So 30 over 130 times. Remember, the unrealized profit is usually calculated on the unsold inventory. And we were to inventory include 360. Buga PLC inventories include 360 million of wheat bought from Kumasi Limited. So 30 over 130 times 360 million. That will give us 30 divided by 130 times 360. We have 83 million Naira. It's already in Naira. This figure is Naira, so it does not require any further translation. So the accounting entry is to debit cost of sales with 83 million, credit inventories with 83 million. That is, in the statement of financial position, this 83 million will be deducted from the consolidated inventories. So since we are debiting cost of sales, That means you are increasing the cost of sales by 83 million. The credit entry will be in the inventory in the statement of financial position. That is all about note 3. Note 4, Buga PLC other operating income comprises management charge to Kumasi Limited of 1.506 billion Ghana cedis for management support given to Kumasi Limited. The charge was paid by Kumasi Limited on September 30, 2023, and is included in Kumasi Limited operating expense in the years. Since it has been included in operating expenses, this is an intercompany management fee. It has been included in operating expenses of Kumasi, and this same amount have been included as other operating income in Buga Limited. So you were told in Kumasi Limited operating expenses, in the future year there will be no management charge, as it is expected that Kumasi Limited will not require Buga management support. So intercompany items should be eliminated. Therefore, since it has been included as other operating income in Buga financial statement, you will eliminate it. That means you credit the other operating income of Buga Limited. Then you also debit the you debit the other operating income in order to cancel it from the other operating income. Remember, income is used to have a credit balance. Then the operating expenses of which have been included, where it has been included, you credit it in order to remove it. That is the double entry required to eliminate the intercompany management fee. So we want to translate this. So 1506. When was it issued? So we want to know the date. You were told Buga PLC other operating income. Okay. We normally use average exchange rate for all profit or loss item 1506 divided by 4.8. Company management fee 1506 divided by 4.8. 1506 divided by 4.8. That gives us 314 million. And this sum have been recorded as an operating income. I've told you income used to have a credit balance. So you want to cancel it now, you debit the operating income. You debit the operating income, 314. Then you credit the operating expenses, 314. That is the double entry required to eliminate that intragroup item. Remember, we said the unrealized profit of 83 million will be deducted from the inventory. The carrying amount of the inventory, so you have the cost of the inventory is 360 million. This is the amount that is still included in the inventory, 360 million. Then you less provision for unrealized profit. And that amounted to 83 million. If you subtract 83 million from 360 million, 360 minus 83, that means you'll be left with 277 million. That is the carrying amount of the inventory. So this is the carrying amount. This is the amount that will appear as closing inventory in the Consolidated Statement of Financial Position in respect of the item transferred. Then you have the tax base. For tax purpose, the computation will be based on the cost, 360. The tax base is greater than the carrying amount. That means this is a deductible temporary difference. No, if you have watched my earlier video on IAS 12 income tax, we categorize temporary difference into two. the taxable temporary difference and the deductible temporary difference. We said the taxable temporary difference arises where the carrying amount of an asset exceed the tax base. Where carrying amount exceed the tax base, you have the taxable temporary difference. But where the tax base is greater than the carrying amount, that is deductible. The taxable temporary difference will give rise to a deferred tax liability, while deductible temporary difference will give rise to a deferred tax asset. So deferred tax asset. Remember, the tax rate given in the question is 20%. So if you calculate 20% of 83, that gives us 16.6. Let me just say approximately equal to 17 million. So this 17 million, the double entry will be to debit the deferred tax asset with 17 million, credit statement of profit or loss with 17 million. So this 17 million now, we will need to adjust for that in our tax in the statement of profit or loss. We want to credit the profit or loss with 17 million. So we have deferred tax of 17 million that will be credited here in the statement of profit or loss. So you credit the statement of profit or loss with deferred tax. Remember, income and revenue used to have a credit balance, while all expenses used to have a debit balance. So if revenue is having a credit balance, revenue of Buga PLC is 3784 and revenue of Kumasi Limited is 2061. We have 5845 as the revenue of both. And we have intergroup revenue which was debited. Since revenue and income, since they are having a credit balance and you have debited the revenue, that means you are subtracting it. So minus 1225. So you have 4620. So the consolidated revenue is 4620. Then cost of sales is an expense. And I've told you that the expenses will be having a debit balance. You have 2480 plus 1476. Since expenses are having a debit balance, and this is debited, that means you are to add it. Then we have plus 83. While this one that is credited is to be subtracted, minus 1225. So you have 2814 as the cost of sales. This is the amount of cost of sales that will appear in the consolidated statement of profit or loss. If you subtract that from 4620 minus 4620, then you have the gross profit of 1806. 1806. Then we have other income. Income is having a credit balance. That means this one is a credit balance, but this was debited. Credit against debit, they will be eliminated. So you won't have anything in the consolidation. Intergroup balances should be eliminated. Then we have operating expenses and finance costs. We have 682 plus 1041. Remember, expenses is having a debit balance. These are debit balance, but this one is credit balance. So a credit entry should be subtracted minus 314. So you have 1409. Our operating expenses amounted to 1409. Now, if you subtract the expenses from the gross profit of 1806, then you have 397. The 397 is the profit or loss before tax. But we have a loss this time around. Okay, it's a profit of 397, since the gross profit is greater than the expenses. So that is a profit. Now the tax. Tax is an expense. That is why we have income tax expense. 184. And this is tax savings. So you subtract 68 and you've debited the expense, you've credited the expense here. Since tax is an expense, that means you will subtract the 17. Then you have 95 as the amount of tax that will be expensed in the period. If you subtract 97 from 397, then you have 302 as the profit for the year. Now, after this, the next section is the items of other comprehensive income. For the purpose of goodwill calculation, let's present the summary of subsidiary net asset at the date of acquisition. Summary, let me have this as working number 6. Summary of Kumasi Limited net assets at the date of acquisition. Remember, the net asset comprises the share capital, then we also have retained earnings on acquisition. Retained earnings. Now, to go through the statement of financial position, you have the net asset of subsidiary, which comprises the share capital of 1,000, retained earnings on October 1st, 2022. If you go back to the beginning of the question, where you have the stake or a stake acquired by Buga in Kumasi to be 80%. That is at the beginning of the question. You have the percentage. You were told on October 1st, 2022, Buga PLC acquired 80% interest in the ordinary share capital of Kumasi Limited. The acquisition is October 1st. Therefore, that's to show that the retained earnings on October 1st of 4810 is the pre-acquisition retained earnings, while the share capital is 1,000. So we want to include them in the summary of Kumasi Limited net assets. We have share capital of 1,000. Then we have retained earnings to be 4,810. Now let's go to note 8. In note 8, you were told at October 1st, 2022, which is the same as the date of acquisition, there were no differences between the fair value of Kumasi Limited net assets and the carrying amounts, except for the valuation of land owned by Kumasi Limited. PPE included land at cost of 3,120 billion. That's to tell you that the carrying amount included in the statement of financial position, we were told it included the land to the tune of 3.12 billion, which had a fair value at October 1st, 2022 of 4.64 billion. So it means the fair value gains has arisen. The difference between the 3.120 billion and 4.64 billion represent the fair value gain. The director do not intend to sell the land. Ghana GAAP does not allow revaluations. So this revaluations is allowed in IFRS. So we now have fair value gains on land attributable to land. So you have the carry amount to be 3,120, and it was fair value to be 4,640. 4,640 minus 3,120 million. The difference between this and this and this. So how much is the difference? 4640 minus 3120. We have the difference of 1520. If you sum this up, plus 4810 plus 1000, then you have 7330. This is the net asset of subsidiary on acquisition. So we can calculate goodwill on acquisition. Work number 7. Goodwill on acquisition of Kumasi Limited. Remember to calculate goodwill. I said goodwill should be calculated in foreign currency, Ghana cedis. And to calculate goodwill, we start with the purchase consideration. Purchase consideration. And how much is the consideration transferred on acquisition of Kumasi Limited? Go to note 1. In note 1, you were told that Buga PLC paid 7 million Ghana cedis for its investment in Kumasi Limited. As Kumasi Limited is not a listed company, Buga PLC intends to use the proportion of net asset method to value the non-controlling interest. Now, remember the NCI is valued on acquisition at the proportionate share of the subsidiary net asset. So the consideration transfer from note 1 is 7 billion Ghana cedis. We had the NCI at acquisition. In that same note 1, you were told to value NCI at proportionate share of net asset. Remember, Buga acquired 80% of Kumasi. That means the percentage attributable to NCI is 20%. So we have 20% of Kumasi net asset on acquisition, which is 7330. 7330 million. So the 20% of that is 1466. Then if you add it to 7,000, that will be 8466. After this, you deduct the fair value of net assets at the date of acquisition. The net asset will have 7330 at the date of acquisition, 7330. If you subtract that, then we have goodwill of 1136. That is goodwill in foreign currency, which is goodwill in Ghana cedis. Then we can translate this goodwill in order to get the exchange gains or loss on goodwill. Working number 8. Calculation of exchange gains or loss on translation of goodwill. So we want to translate it to Naira. Goodwill at opening rate. And the goodwill amounted to 1136. And what is the opening exchange rate? If you go to note 10, the opening rate, the beginning of the year, which is October 1st, and we have that to be 5.4. So goodwill at the opening rate of 5.4, that will give us 1136 divided by 5.4. So we have 210 approximately. Then we also have goodwill at closing rate. So we translate the goodwill at the closing exchange rate. And the closing exchange rate from the same note 10. The exchange rate at September 30, 2023, that is 4.2. 4.2. So if you translate it, 1136 divided by 4.2, so we have 270. 270. So the difference is 60. Since the closing balance is greater than the opening balance, so that means this 60 represents exchange gains. It is an exchange gains where it is negative. So don't say because this closing is because it is negative, don't think it is a loss. So we have exchange gains. Normally, if you want to have positive, you will have taken the closing minus the opening. That is how it should be in order to have a positive result. Now, the loan that were issued in note 7. So we need to ascertain the exchange gains or loss arising on that loan. On April 1st, 2023, so the loan was issued. Buga PLC made additional investment in Kumasi Limited when it provided a loan of 3.2 billion Ghana cedis to Kumasi Limited with interest payable at 5.25%. So, we per annum in arrears. Buga PLC does not require repayment of this loan in the near future. No adjustment have been made for this loan other than to include it in Buga PLC non-current asset at the rate of exchange at April 1st, 2023. So, the rate of exchange on April 1st, 2023 was used to translate or in translating this intercompany loan of 3.2 billion Ghana cedis. So no entries have been made in either company in respect of interest on the loan. Interest is starts on an accrual basis. Now, working number 9. Working number 9. Exchange gains should be negative or loss on investment in loans notes. Remember, this loan note, the investment was made on April 1st, 2023. And the loan amounted to 3.2 billion Ghana cedis. And the exchange rate at the date the investment in loan notes was made, which is April 1st, 2023. April 1st, 2023, the exchange rate is 4.4. So that means we use that 4.4 to translate it. Divided by 4.4, we have 3.2 divided by 4.4. That gives us 727. 727. At the year end is September 30, 2023, 3.2 billion. And what is the exchange rate at the year end, which is September 30, 2023. September 30, 2023, the exchange rate is 4.2, and that loss will be translated at exchange rate at the year end, 4.2. So 3.2 divided by 4.2, that gives us 762. 762. 762. So the difference is 762 minus 727. That gives us 35. The exchange gains on translation of the loans, investment in loan notes, exchange gains. So we have that to be 35. It is still a gain. Don't say because it is negative that it should be loss. So working number 10. Exchange gains or loss on translation of subsidiary net assets. Exchange gains or loss on translation of subsidiary net assets. So you start with opening net assets. Opening net assets at opening rate. And the opening net asset was obtained from working number 6, from the summary of subsidiary net assets. And we got 7,330. 7,330 Ghana cedis. Now, how much is the opening exchange rate? You know, the opening entry happens on October 1st. The exchange rate at 1st of October 2022, and that is 5.4. So we use that to translate that. Divided by 5.4. So we have 7,330 divided by 5.4. That gives us 1,357. 1,357. Then closing opening net assets translated at closing exchange rate. Closing rate. The opening net asset is 7,330. And what is the closing rate? That same note 10. So we have the closing rate, exchange rate at September 30, 2023, and that is 4.2. So we use that 4.2 to translate it. Divided by 4.2. So we have 7,330 divided by 4.2. That gives us 1,745. The closing balance is greater, so you have the exchange gains of 1,745 minus 1,357. So we have 388. 388. Then you also translate the profit for the year, which was obtained from updating and translation of subsidiary statement of profit or loss. From updating and translation of subsidiary statement of profit or loss, we have the profit or loss for the year of 1,859. This is a loss because it is negative amount. From working to, where we did updating and translating of subsidiary net statement of profit or loss. we got loss of 1859. So we now have exchange loss on translation of profit for the year at average rate. You know, we got 1859 as the profit for the year from working number 2, where we did updating and translating. So the average exchange rate is given to be 4.8. 4.8 average for the year to September 30, 2023. That is 4.8. So we want to use that 4.8 to translate it, divided by 4.8. So we have 1859 divided by 4.8. So this is 387. 387. This is an exchange loss because it is loss we translated. Exchange loss on translation of loss for the year at average rate. Then exchange loss on translating the loss for the year at closing rate. The loss is 1859 divided by the closing exchange rate. That is exchange rate at September 30. Exchange rate at 30th of September, that is 4.2. So we want to translate it at that rate of 4.2. 1859 divided by 4.2. That gives us so we have 442. So the difference is 442 minus 387. That gives us 55. So we have exchange loss of 55. So if you subtract the exchange loss of 55 from exchange gains of 388, so you have 333. That is the exchange gains on translation of subsidiary net assets. So the sum of all these three exchange gains, the exchange gains on goodwill, exchange gains or loss on investment in foreign operations, that is in loan notes. So if you sum up the three exchange gains, that will give you the amount to be recognized as other comprehensive income. Working number 11. Exchange gains to be included in other comprehensive income. Exchange gains to be included in other comprehensive income. So we have exchange gains on translation of subsidiary net assets, gains on translation of subsidiary Number 1, net asset. That is working number 1. And working number 10. And we got 333. Gains on translation of subsidiary goodwill. That is working number 8. Gains on translation of goodwill, and we got 60 million. That is working number 8. 60 million. Gains on translation of investment in loans. That is working number 9. Working 9. And we got 35 million. 35 million. So, the addition of the 3 will give you the gains to be included in other comprehensive income. So, how much is the total? 333 plus 60 plus 35. That gives us 428. The NCI share of the gains. The rounding of errors is permitted. So the percentage attributable to non-controlling interest is 20%. So we have the 20% of the gains on translation of subsidiary net asset, which is 333 million. So 20% of 333, that gives us approximately 67. We have 66.6, which is approximately equal to 67 million. If you subtract that from 428 million, we have 361 million. 361 million. So, other comprehensive income. Other comprehensive income. So, we have exchange gains. Exchange gains on translation. So we have exchange gain of 428 million, working number 11. 428 million. Working 11, 428 million. If you add the 428 million to 302 million, so that will be totaled 302 plus 428. Then we have 730 million. The 730 million is the total comprehensive income for the year. Total comprehensive income for the year. Now, after the consolidated schedule, we can now prepare the consolidated statement of profit or loss of Buga PLC Group. We have Buga PLC Group. Consolidated statement of profit or loss and other comprehensive income. Income for the year ended September 30, 2023. Amount in million naira. The first item will be revenue. revenue. We have revenue of 4620. 4620. 4620. After revenue, we have cost of sales. Cost of sales. We have the cost of sales of 2814. 2814. If you deduct that, you arrive at the gross profit. Gross profit of 1806. 1806. There is no other operating income. So since that is nil. Then we have operating expenses and finance cost. 1409. Operating expense and the finance cost, which is 1409. If you remove 1409 from 1806, then you arrive at profit or loss before tax. And that amounted to 397. Profit or loss before tax. We have income tax expense, we have income tax expense of 95. Income tax expense, we have 95 million. Then after deducting 95 million, you have profit or loss for the year, 302. Profit or loss for the year, 302. After that, we have other comprehensive income. Other comprehensive income, which include exchange gains on translation of subsidiary. Exchange gains. We have the exchange gains of 428 million. 428 million. If you add the 428 million, the total is 730 million. The 730 million is the total comprehensive income. Total comprehensive income for the year. Total comprehensive income for the year. This profit for the year will be shared between the parent company and the non-controlling interest. You know, we have the profit for the year of 302. So we have profit for the year attributable to, we have the owners or parent, and we equally have the non-controlling interest. The total profit for the year, as calculated above, amounted to 302 million. Then, this 302 million will be shared between the parent company and the non-controlling interest. Then you equally have total comprehensive income for the year. Total comprehensive income attributable to the owners or parent, and the non-controlling interest. So we have the total comprehensive income amounted to 730 million. And this 730 million will be shared between the parent company and the non-controlling interest. Remember, if you have watched my earlier videos on Consolidated Statement of Profit or Loss, I have told you that for the purpose of NCI calculation, that is always necessary to calculate the adjusted profit of the subsidiary. So now let's have the adjusted profit, working number 12. Adjusted profit of Kumasi Limited. To calculate the adjusted profit, the starting point is profit for the year relating to the post-acquisition period. And we have the profit of negative. So this is a loss. Can have profit or loss. Since it is a loss, 388 loss. I've told you that the unrealized profit will need to be adjusted where subsidiary is the seller. Remember, Kumasi sells to the parent, and the unrealized profit has calculated 30 over 130 times, I think, 3.2 million. We got 83 million times. So we got 83 million when the unrealized profit was calculated. Go back to our earlier working. So the adjusted profit will be 388 plus 83. We have a loss of 471. So of this 471 million, 20% of that will be attributable to NCI. 20% of 471 million. So NCI shares of that will be 94 million. So negative. Then the one attributable to the owners of the parent, since this is a loss, you can add. You add it. But if it is profit, you subtract it. But since it is a loss, 302 plus 94. There you have 396. The profit attributable to the owners of the parent is 396. So if you have 396 million minus 94, it will give you 302. Then the NCI. Then you have 94 million loss. 94 million minus from working number 11. We have NCI shares of exchange gains. We got 67 million from working 11. When we calculated 20% of 333, so we got 67. So 94 minus 67, that gives us 27 million. The total comprehensive income attributable to NCI is 27 million negative. So add it to 730. So we have 757 million positive. So the total comprehensive income attributable to the owners of the parent is 757 million. So this marked the end of the solution to the question. Please drop the love emoji, like the video, also share it with others. Thanks for watching ACCA.